Welcome back to Cheddar Business, everyone. President Trump considering imposing tariffs on about $11 billion worth of goods from the EU in response to subsidies that support Airbus there. Joining us now is Eddie Ghabour, co-owner of Key Advisors Group and author of The Common Sense Bull. Eddie, it's good to have you with us. $11 billion potentially in tariffs. What could that mean for the markets?
So I think from a short-term perspective, the first thing we have to do is see if this is actually just noise or it will be implemented. If it is implemented, there's no doubt that tariffs have a negative impact on the stock market from a short-term perspective. I truly believe the reason why the administration has been taking such a tough stance with China and the EU in regards to trade is because they're looking at the US as the strongest economy in the globe right now, and they feel as though we're in a position of strength. And so using tariffs, although not popular with the markets and it's an additional tax, can be an effective way to negotiate. No one wants to see it from a market perspective, but at the same time, I think we understand why they're doing it. But again, we hope it doesn't lead to a massive trade war where now you have retaliations and huge tariffs coming from both sides that will hurt earnings and growth potential from this global economy we live in today.
Well, Eddie, that's exactly what has seemed to happen between the U.S. and China now that the U.S. has imposed tariffs on pretty much more than $200 billion worth of goods that come in from China each year, and China's retaliated.
Yes, they have. And look, you're seeing with the multinational companies that it's hurt their earnings. And I guess the hope is that there's going to be some short-term pain for long-term gain. But if that does not happen, it can be detrimental to the global economy. You're already seeing it globally overseas slow down in recessions, and the hope is that it doesn't spill over to the U.S., but that risk is there. If these tariffs continue to go in force for an extended period of time, there's no doubt it's going to have a negative impact on the economy.
Let's talk about the $11 billion figure, because the U.S. does bring in hundreds of billions of dollars worth of goods each year from the European Union. So $11 billion seems like a really small amount. Obviously, it's a very targeted on certain goods and services in response to something very specific. But what's the worst case scenario here in terms of how that figure grows?
Well, the worst case scenario is to see how they respond to our threats of tariffs. Because what will probably happen is they'll come back and say that they're going to put tariffs on some of our goods, and then our administration may come back with an even much larger number, and then you go into an actual trade war. And again, that can escalate and balloon and have some unintended consequences that will absolutely hurt the equity markets from an earnings perspective.
I just think it never ends, right, Eddie? If you're an investor and you're trying to get into Trump's psyche, I mean, what we saw with Mexico last week, they had a deal, USMCA, then he said, look, they're not holding up their end of the bargain, so we're going to come down hard on them for something else. I just think that if you're an investor, right, that's kind of the reality that you got to get used to, no?
Yeah, as an investor, it's a very tough environment from a volatility perspective. I mean, all we have to do is look at the last 6 months where you have a 15% down quarter, and then you come back in the first quarter of this year with a plus 15%. So trying to time this market on a short-term perspective for a novice investor is very difficult, because I don't think this volatility is going away. And I would expect some short-term pullbacks here with the market having as strong as a quarter as it did when we still have China and the EU now in regards to trade still as a major risk that I don't think the market is pricing in a bad case scenario right now. It's kind of ignoring that noise.
It's interesting.
Yeah, go ahead.
I was just going to say, we have turned lower here in the markets. The Dow down 200 points. Eddie, we opened down about 100 points. We do see that the IMF cutting its global growth outlook to its lowest since the financial crisis. In addition to that, we know that concerns about earnings are very real, with earnings in the first quarter expected to fall by more than 4% for the first time in nearly 3 years. How does that add to the volatility that you see in the market?
Well, it's only going to add and increase that volatility from a market perspective. I think a big deal is going to be on Friday when some of the banks start to come out with their earnings. That's going to be looked at very closely. If they disappoint drastically on the downside, because keep in mind, they've already, financials and other companies have kind of set the bar a little bit low. So if they disappoint even lower, I think you can see a massive sell-off on a short-term perspective. The one silver lining I will say for the financials when they come out with their earnings is you have seen a tremendous amount of increase in refinances with the 10-year note coming down quite a bit. And I would expect to see that in the second half of the year help on the real estate market and loan growth. So whether that's reflected in Friday's numbers is yet to be seen, but that is a silver lining with what's happened now in the interest rate market for the second half of 2019.
Eddie, I want to specifically talk a few companies here, airlines and Boeing, of course, because the Dow's story has over the last few days been about Boeing. Boeing down today. It was down yesterday after that Bank of America downgrade. Today we're getting news that American Airlines cutting its first quarter revenue guidance because of the 737 MAX grounding. Yesterday it was Southwest that did the same. How bad is this going to get for Boeing?
You know, I think it's still too early to tell in Boeing. I think if you're, as an investor right now, if you're trying to buy it for a short-term trade, I think that's a very dangerous game to play right now, because it's really going to amount to see how bad this escalates in regards to orders. You know, if they start to get a big decline in orders, that's going to really hurt Boeing. They're already going to be hurt short-term from a cash flow perspective and an earnings perspective. But if this escalates in balloons to something massive, because this company has put a lot on this 737 MAX, and if it ends up, you know, not working out and everyone starts to abandon it, it's going to have some troubles for this company. Yeah. I'm cautiously optimistic long-term the company will navigate through this, as long as this software they're going to be putting in place to try to help make it safer comes to the marketplace sooner than later. I think that will help. But in the short term, again, it's dangerous ground. And that's why you're seeing it flow into the airlines, because they rely on this 737 MAX quite a bit.
Right, tens of billions of dollars, more than $50 billion on the line when it comes to these orders, the order backlog for that 737 MAX 8 model. Eddie, we got to leave it there, but thank you for joining us.
Thank you.